There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way
Welcome back, traders and investors. We have Kate Stalter on the line. She's an investment advisor, a portfolio wealth advisor, and a columnist for Forbes, and more importantly, a columnist for Benzinga. Kate, how you doing this morning?
I'm doing great. Hey, you know what? I actually realized I forgot to update my bio with you guys because I now have my own firm called Better Money Decisions. So that's just some very exciting news. Just happened a few weeks ago, and I'm also thrilled to be a columnist for Benzinga these days too.
Tell us about this new website there, Kate.
Yeah, it's my new firm is it's a registered investment advisor. So I work with folks who are saving for, different objectives in life, whether it's retirement, whether it's a kid's education. Those are some of the most common things that people save for. And just super, super excited to have some great ways of working with people, bringing some of the solutions, to questions that people have. How do I create income? What's the lowest cost, most efficient way to do that? And that's really some of what we were going to talk about a little bit today, too, is just really how to make your investments work for you. I know that a lot of the folks who listen to Benzinga and who read the website, I know that people like to trade individual stocks, maybe options, and that's fantastic. That's terrific. But what happens a lot of times is that people who like to do a lot of that kind of trading kind of neglect their longer-term investment philosophy. And that's really what I'm focusing on.
Okay, so are you recommending mutual funds? There's all these ETFs, and I know you can trade some of them pretty cheaply in retirement accounts, almost for free through some firms. So you stick with the mutual funds, or if not, what are your core and satellite strategies?
Yeah, that's a great question because I know exactly what you're talking about is that people love ETFs because they're tradable intraday, and I get that. That is a terrific advantage. A lot of times, though, what I warn people about is be very, very careful because not all ETFs are created equal. So you get some of these that aren't really pegged to a traditional index. They're kind of gimmicky. The costs in ETFs, and some of them, can be higher than the costs in some indexed mutual funds. So that's really what's at the heart of the core and satellite strategy, Joel. I'm not advocating necessarily a mutual fund versus an ETF because there's lots of ways you can go to achieve the same objective. For example, let's say that in your 401k, for instance, not an account that most people are or should be trading actively, but just in your 401k, you want something at the heart of that that's inexpensive, that is tracking a major commercial index. So just for the sake of discussion, let's call it the S&P, which is the one that most people use. There's a lot of ways to get S&P exposure. You can do the SPY, the ETF. There's a number of mutual funds that are really passively managed, which means nobody's picking stocks, it's just tracking the S&P, that's just as inexpensive as many of these ETFs. So that's really the core and satellite approach is you want something at your core of your retirement savings portfolio that is going to be very efficient, very cost effective, and lowers your risk. You don't want to be placing kind of crazy bets at the core on something like emerging market debt, for example. Does that make sense?
Yeah. I think you just got to try to keep it as simple as possible, too. What are your thoughts on the levered funds? Because some of these things, triple long, triple short, people put these in their investment accounts, and then they watch them go down, and they think when you buy these triple long funds that the market's up 20%, well, I'm going to be up 60%. That's not the way they work, right, Kate?
Exactly. Yeah. You know what? First of all, I would say unequivocally across the board, do not use these things unless you're an active trader that is monitoring your trades on a daily basis, if that's what you do and that's in your trading account, then perhaps. I think they're very risky. I have never, I don't believe these are appropriate for most investors. I'll tell you something. A few years ago, for Money Show, I used to write a column over there, and I interviewed Dan O'Neill, who is the president of Direxion Funds, which is one of the companies that is a leader in creating these products. Dan O'Neill himself told me these are not appropriate for investing. These are trading vehicles. So, yeah, you're absolutely right. People should not be messing around with these.
Okay, Kate. So, when you're looking at mutual funds, are you always looking for the ones that have the best performance track record?
That's the way most people go into this. Like, say you're allocating your 401k, and most people, and I understand this, you don't really know where to begin. So what a lot of people do is they'll kind of look up the Morningstar ratings, which is a great place to start doing your research. Nothing wrong with that. However, just because something has had a great track record over the past 3 to 5 years, what's the old saying? Past performance is no guarantee of future returns. That's absolutely true. So really, no, that is not the place you want to begin, especially when you're just looking at indexes. You really, the place to step back and begin is, rather than just looking at a list of stocks and picking the ones that have the best performance or the most stars in their rating, best place to begin is looking at what are you trying to achieve. So say you're trying to fund a retirement. Say you're 35 and you're thinking maybe retiring 30 years from now. Okay, you've got a long time in there. You might want to say, okay, I can put more equities in my portfolio right now while I'm 35 years old and take some more risk for a couple of decades, and look at it from that point of view and then decide what kind of equities are best in there. You want U.S. large cap. You want some international small cap. So really, it's a very strategic approach that does not begin with just looking at what's been a top performer in the past few years.
What about the management expense ratio? Do you look at that? Because some of these funds can have 3-4% MERs, and those can really eat into your return, especially if the long run the market's only giving you 6. Well, they might say, oh, we're only charging you 3 a year. Well, if you add that up, if the market's going to average 6, they're taking half of your return. So that's something you got to watch too, right, Kate?
Oh, incredibly, yes. That is one place. While you're doing your research, definitely be looking up the expense ratios. Just the way the industry works is those are kind of, it's not hidden, but they are embedded in there, and people don't really notice that because they get blindsided by looking at the performance rather than the expenses. So, if you're looking at an index fund, first of all, those are going to be a lot cheaper because they're not actively managed. So your expense ratio on an index fund really should be under 1%. The other problem with that, I think people overlook the expenses and what that can do to your returns, is because they're relatively small numbers, right? It's like 1%. You're like, oh, that's not much. Or maybe even 2%. And if you're getting into the realm of a fund that's charging you 2%, that's an actively managed fund. You got to question that to begin with. I would say almost unequivocally that kind of expense ratio is way too high. But yes, the short answer to your question, you really have to look at that when you're selecting a fund.
I was going to say, okay, so you were just talking about more actively managed funds. Do you like the index funds better that have the smaller MERs, or do you think there is a place and time to be buying the larger, or to be buying the more active funds that have the higher management expense ratios?
Yeah, and that comes back to the core satellite approach, really. There can be a place for some active management. And in other words, what that is when you're paying somebody to pick stocks. So, for example, if you, let's come back to the example of the S&P 500 being at the core of your portfolio. So say you have that, say you have a small cap fund maybe tracking U.S. small cap, say the Russell 2000, for example, then you want something that's maybe REITs and the real estate investment trust. You want some exposure to that. Now, there are indexes that can do that, but you could get some kind of active fund where somebody is picking REITs. That's okay as long as you're aware that you're getting into the realm of active management, that you're using it for a particular reason to fill a particular need in your overall investment strategy. And once again, that you're very, very cognizant of the fact that your expenses could be higher if you're doing that. This is where, when you talk about long-term investing, sometimes people think, especially active traders, people tend to think it's set and forget. That's not really true. That's not really true, because especially when you're doing a core and satellite approach where you're bringing in some active management as your satellite investments, those you really do want to evaluate on a regular basis. Make sure, is this an opportunity to add more to a position, or is it an asset class that's out of favor right now? It's very interesting because you can look at some of these charts for sectors, regions, different asset classes. You can see that it is impossible to predict which one's going to be in favor or out of favor in any given calendar year. So yeah, you do need to watch this carefully, and don't just set and forget.
So you're not a big fan of the sector or the regional funds. You look for a more diversified approach?
You can use them, but again, you have to just be careful with them because, for example, this is a great example. Say you made a sector bet on technology in late 1999 or early 2000, okay? And then you started dollar cost averaging into that. Even as it corrects, even as, the tech sector in the market hit their peak in March of 2000, say you continued dollar cost averaging into a technology ETF or mutual fund, okay? You'd still be waiting for that thing. You would still be, because technology has not been one of the leading. There have been other sectors that have outpaced that growth over the past 15 years, 14, 15 years. So that's a very, very good example of why you have to just be careful with the sectors or regions, because even the ones that you might predict, that you might read about, or you might hear on TV that are supposedly the leaders, well, you know what, that's just some pundit saying that. And I think all too often people jump into one of these sector or regional investments because they get an idea that it's supposed to be hot right now. It doesn't always work out, and it's not always a long-term proposition. So if you're going to do that, again, you have to watch it carefully and know when is the right time to exit, if appropriate.
Okay, we're running out of time here, but in 30 seconds or less, can you just give us your general outlook on the market here, and have we seen a shorter long-term top?
Yeah, here's what I always say about this. I have a pretty standard answer.
Okay, let's hear it.
Okay. There is always a correction coming. There always is. So, when people get into predicting, there's a correction coming, yeah, there will be. It's just a matter of, are you prepared for that? Do you have a portfolio that's constructed to withstand a long or short correction? And how are you going to respond to this in terms of taking advantage of buying opportunities or selling when appropriate? So always be prepared for that. That's my answer.
That is a great answer from Kate Stalter. She has started her new firm, Better Money Decisions. She's also a writer columnist for Forbes, Real Money, and also Benzinga. Kate, thanks for coming on today. Have a great day. We hope to speak to you again soon.
Oh, absolutely. Thanks a lot.
Okay.